Before we begin, here's how to earn continuing professional education credit for attending this session. Gain valuable insights by attending the podcast, then complete the assessment test to download your certificate. To do this, follow these simple steps. Click on the link in your description to access the session. Create a free account and attend the podcast. After the podcast, take the assessment test and download your certificate. It's easy, and it's free. We highly recommend checking out our subscription. Let's get started.
I want to talk to you about this. Another thing that I'd spoken to this other gentleman in one of the prior podcasts, and he says that whenever you're thinking about, for whatever reasons, if you're thinking to either bring in private equity for whatever reasons, or you're looking to sell, the firms. I mean, everybody says this: you need to get your house in order. All right. So, what does it actually mean in practice? Are we talking about financial hygiene, leadership alignment, client mix, or all of the above?
Yeah, well, it's probably all the above. I'd say at Winding River, we're focused on kind of six core table stakes for firms when they're thinking about it. You can kind of phrase it around what I would call a value creation plan inside the firm. In many ways, it really starts out, and all the rest of them, to me, kind of come off of this one, and that's: do you have your North Star and your vision defined? And
Yes.
most of the time, when I'm talking with firms, they don't know what that really means. And so we'd spend a lot of time on that particular topic. In fact, I'm working with, one pretty sizable firm in the top 100 on that very thing right now. And, and kudos to them. They got themselves out of the thinking, what I call Horizon 2 thinking, and what that really can mean for them. And it's hard and challenging. But once you have that in place, then I think you got to focus on developing your strong leadership team. So a lot of times, firms have had, leaders that have come up through the firm, and I was no different. So I learned how to be a growth officer. It wasn't something that and I had to work hard at that, right? And you got to spend the time.
Welcome back to Accounting M&A Insider. I'm your host, Saul, and today's conversation is one I've been looking forward to. Our guest is someone who knows what it's like to sit on both sides of the table. First, as a leader scaling one of the nation's largest firms, and now as an advisor guiding others through a complex world of growth and deals. Joining me is Brian Blaha, Managing Director at Winding River Consulting and Chair of the Illinois CPA Society. Brian has spent nearly 3 decades at Wipfli, where he went from an intern to Chief Growth Officer, building offices, leading strategy, and executing over 40 acquisitions. And now he helps firms, big and small, figure out how to scale, when to say yes to a deal, and just as importantly, when to say no. Brian, welcome to the show.
Thanks, Saul, for having me. Looking forward to the discussion.
Absolutely. Now, Brian, you spent close to 30 years at Wipfli, starting as an intern and working your way to the C-suite. That's quite a journey, honestly. So, can you walk us through what that path looked like and what you learned along the way?
Absolutely. Yeah, it was a great ride. I'd say kind of the keys to advancement throughout a firm are really just kind of having curiosity, being super curious about new things, willing to try new things,
Yep.
leaning into opportunities when they're presented to themselves, and ultimately being okay that there might be some failures along the way. So kind of my journey, right? I came up through the firm, much like probably a lot of your viewers. I started in audit. I guess I started as an intern, which I had an opportunity to work in our small business practice, which actually kind of gave me the baseline or the foundation. It's akin to today would be your CAS practice, which they didn't call it that back then, of course. But then started in audit. But I had an opportunity to get right into a niche area because at the time, Wipfli had 2 strong niches in healthcare and financial institutions. And I saw an opportunity in financial institutions. And so I dove into it. And there's a little bit of a a fear factor, I think, in many cases for young professionals to say, hey, I'm going to limit my career by going into one area. But for me, it actually worked out really nicely that it was something where there was a lot of opportunity, and I ended up really liking the space, in the financial institution sector. Kind of fast forward, I had the opportunity to move from Green Bay, Wisconsin to Chicago. And it was one of those things, I felt like it was a little bit of a musical chairs type of thing, and the music stopped on me. and it was, I remember going home to my wife and saying, hey, what do you think about moving to Chicago? And she was like, you're kidding. And ultimately, we decided to do it 14 years ago. And, it really kind of scratched my itch to be a builder. And that's kind of been a thread throughout my career as well. I called it at the time entrepreneurism, because it allows you to be an entrepreneur inside of a large organization. And so, we packed up the truckster and moved down to Chicago. And a lot of people ask me, was it a merger at that point? And it wasn't. It was, in reality, it was, our practice in financial institutions was needing to expand, and the firm wasn't quite ready for the merger, or we couldn't find the right merger at the time. So I literally moved down and started a practice from scratch. And I know we're going to get into that a little bit, but that was just a great time for me as a professional. During that time, during that period, I was elected to the Wipfli board. So that gave me a chance to see kind of the whole firm. You get a chance to work with the leaders, understand all the complexities that are going on. And then ultimately, I was asked to be the firm's chief growth officer, the first chief growth officer of the firm. And that was, I guess, 9 years ago now. And I served in that role for 8 years, and really developed, what our go-to-market strategy was. I oversaw industries, geography, marketing, and sales. And it's obviously much more evolved today when I left. So I really, when you think about that journey, it really was a natural progression. Every kind of step of the way built upon itself.
I agree to you. And there's something about the audit industry. Honestly speaking, I also started my journey in the audit industry, into internal audit for a stockbroking firm. And here I am.
And here you are doing podcasts.
Absolutely. Absolutely. But I also know that, you were instrumental in building the Wipfli's Chicago office from scratch, scaling it to hundreds of people. So that's no small feat at all. So what was that experience like, and what made it successful?
Yeah, you kind of look back on it, and it's probably could be turned into a master class on how to inorganically and scale. So if you think about it, I remember those early days. I was sitting, we had gotten this, a sublease office, and I'm sitting there going, what the heck did I just do? And you realize that you got to start putting one foot in front of the other and start developing. One of the big things I did early on was I developed and developed a framework, and looked at all the different banks. We looked at a 6-county area around Chicago. I remember the number, it was 165 institutions that were on the list. We took off the big ones and took off the really small ones, and we ended up with 165 at the time. Ultimately, what I did was I created this relationship. Okay, where do we have relationships? Do we have anybody that influences those relationships? And so I built this model out, and we were really diligent on it, especially in the I'd say first 3 or 4 years of the build, because ultimately advancing a relationship from one category to another felt like a win, even though they weren't a client yet. So we really worked that process hard. And then we even did it when they became a client, because as you know, you don't get to be a trusted business advisor status out of the start. So there's a process that you need to go through, even with a client that you might get a entry in with the CIO as an example, and ultimately trying to track through the firm, through that company into the CFO chair or the CEO chair as an example. So then it was, okay, how do we build the team? And I made a key hire probably about 6 to 7 months into the build. It was a CFO of a bank, and I had taken her out to lunch, and about 3 minutes into the lunch, she goes, actually, I know you're here to sell me, but I actually want you to hire me. And, one of these, like, I took a step back, and I was like, okay, well, let's reframe the brain and let's have a different conversation. And so we started talking about it. And a couple months later, she ended up joining the team. And together, her and I really then hunted in pairs. She had she knew the market really well and had relationships that I would have taken years to build, honestly. So that accelerated the process. So we ended up growing to about 10 people ultimately before some things happened, and then probably accumulated about 25 clients, which doesn't seem like a lot, but the average client size was larger, and so it started to generate some nice revenue. Then we had a hole in our service offering in the market, so we found a boutique consulting firm that had about $1 million in revenue and about 7 people and 25 clients. And so we were able to convince them that they should join the team and so forth. And ultimately, then we went from 25 clients to 50 and 7 more people on the team. And the reach just that, again, a whole nother network that we didn't have. So it's just like it compounded upon itself. And then all of a sudden we could open any door that we wanted to. At the same time, we also merged in, the firm was talking to a $4 million local firm that was in the same alliance that we were in, and they joined actually on the same day. So we went from a single niche office with 20, 25 people to 50 people, and now multi-niche firm. And so just then from there, things just started to really compound on itself. And then we did, 8 other mergers and, ultimately, grew organically and obviously scaled it to the numbers that you articulated previously.
Do you want to earn CPE credit? Take this course of MyCPE 1 to earn free credit. Click the link in the description to get started.
Well, Brian, the way you say it, it appears like it's very easy, but I know that it's not as easy as it seems. But I think the key learning from here is you have actually done, which a lot of firms are still struggling with. If you are entering into a new region, I think you landed on 2 very interesting things. One was that you were able to partner with an individual who saw the opportunity of working with you, who knew the local market. So you're able to get that local market expertise. And second was that you were able to tap into that opportunity of identifying firms that were aligned to the vision of your company and get them on board and then eventually grow. So I would say it's a perfect combination of luck as well as a business acumen, if I were to say it that way. So it's kudos to you.
One thing to point out on that small acquisition, and this kind of played out in some of those, as we get in, that Wipfli 40 acquisition story, boutique acquisitions like that, some people shy away from. It's like, well, it's only $1 million of revenue and so forth. I actually think they are more akin to an organic growth strategy where it helps you accelerate, because in essence, you're buying this little nugget of, it's almost like a starter kit for a fire, right? And it just, can grow from there. So I'm a big proponent if you can find those. They're out there.
Yeah. Yep, absolutely. They are all there. And then after years of leadership, you made the leap into advisory with Winding River, right? So what drew you to that transition?
Yeah, it's a pretty big one, but people always ask me, I was like, how's it going into consulting? And then I have to remind them that I spend, the first 25 years of my career in consulting and advisory in the audit side of the business. So it's, kind of going back to roots in many cases, but there's a couple of things. I think you get to a point in your career, 8 years in that role, you kind of, you built the firm, you're in a much larger firm, the job changes in a lot of aspects. And then you kind of do a little reflection and say, what are the things that are important to you? And when I did that reflection, I realized I love building things. And while there's still an opportunity to build, and you see it with all the PE firms that we'll get into, I'm sure today, they're obviously growing big and scaling, but it's not the same as building in an entrepreneurial fashion. And so as I started to reflect, I'm like, that was a big thing for me. Then I realized, you mentioned I'm involved in the Illinois CPA Society. So, that's been an important aspect of my career, being involved in the profession. And I had this kind of inkling that a one-to-many approach was important to me, where I could share some of the knowledges that I had in scaling a firm like Wipfli, but helping firms of all different sizes, on their journeys. And that was really appealing to me. So I kind of get the best of both worlds. Winding River actually checked all my boxes. I get to help build a firm because at the end of the day, we're still a business that we can scale and build, but I also can help clients, in their journey as well. And I get to stay in the profession. So you kind of check my all my boxes.
Well, I think what you described is what a lot of people are still not aware of. There's a Japanese term called ikigai, right? Iki means to live and gai means to reason, and we really translate to a reason to live. But it's not just a reason to live, but it's also a philosophy for work or what you're doing today. It's a combination of what you love, what the world needs, what you're getting paid for, and what you're really good at. When you bring it all together, which gives you that passion and that mission for that profession, and somewhere you found that ikigai, you just didn't know it, and now Winding River is a result of it. So I think that's really amazing. So thank you for sharing
I,
that story,
I
bro.
love that term. Thanks for sharing that.
Absolutely. Now let's talk about deals, right? You said before that many first time buyers just don't have the deal acumen, right? So, what are the most common blind spots you see when firms try to buy for the first time?
Yeah, there's quite a lot. I mean, I think one of maybe the I don't know, misconceptions, but M&A is a process, right? And it takes time, and there's lots of different nuances and steps to it. So if you're a first time buyer, it kind of sounds kind of easy, right? You go in and say, oh well, we'll strike up a deal, and then we'll close it, and then we'll move on, and we'll get going. But there's you really have to follow the steps in earnest, and so I think that's kind of why do buy side M&A advisors exist? It's for that reason, right? To help clients through that process and so forth. So I think there's that aspect of it. So some of the things I see in first time buyers and even more experienced buyers is that a lot of times buyers are opportunistic. And so, it's like you see a deal come across or you meet someone and it's like, oh, we'll chase that thing. And you see a lot of like shiny penny syndrome, or the term we used to use was squirrel. It's like, oh, well, there's this, and you're off to this over here. And it's like, wait a second, I thought we were going in that direction. And then you can see, firms get into a bad situation because they chase something that maybe wasn't entirely on strategy. So that becomes a really important point. I also see that firms generally are fairly weak at financial modeling for their own business, which is kind of interesting because we're CPAs, right? And you think, well, we should be good at that. It's something that we do every day with clients. But when it applies to our own business, we don't spend the time and do it. So, you see gaps in how they look at their investment in their own inorganic strategy, how they evaluate their return on investment, as an example, but like how long they're willing to give that return on investment to actually actuate itself, what good looks like. So there's all those different aspects that I think an advisors can help firms think through. And then maybe I'd end with, I think, don't underestimate. A lot of times firms underestimate how long due diligence takes. And then
Yes.
so and we can talk more about that, but and then it's the legality aspects of it, or as you're doing due diligence, we've seen deals, and I've even experienced them, where things fall apart because there was some legal issue that popped up. But those things tend to pop up at the end of a deal, and I don't know if it's because the seller is holding those close, and it's like they know that it's going to probably blow up the deal, and they want to see if they can get away with it. I don't know what happens, but I've seen that happen a bunch of times.
Yeah, and I couldn't agree more. In fact, this is something that I also talk in my webinars, and I try to educate on this, that uh, they need to be aware, especially first time buyers and first time sellers, they need to be aware of a term called deal stamina, right? The deal is going to take its time. There's a process to it, and it takes its time. And also, they don't have a clear understanding of the due diligence process. They because then there are, like you give everything, and then there's a financial due diligence happening, and there's a legal due diligence happening, and then there are questions coming across, and the sellers sometimes tend to get uh, frustrated that, hey, come on, I mean, are you saying that I'm not saying the truth? It's not like that, I just want clarity on it. But that kind of like burns things on, and then it does not go in a right direction. I mean, that's a very messy thing that happens. But it's only
100%.
through clarity, it's purely it's definitely through clarity. And that's why we do this podcast, so people know that this, like you rightly said, mergers and acquisition, it's a process. It goes through phases, and there are steps to it, and there's a reason why those steps are there. And once you go through those processes, and you know exactly what's there in the process, if you know it beforehand, you can be well prepared for it, and you can ensure that it goes to the solution that you're looking for. So that's pretty much it. Now, one thing I often hear from smaller firms is, it's really funny. I've heard this a couple of times. If the numbers work, the deal works. But I know that you'd say there's more. There's way more to it, right? How do you help firms evaluate if a target is actually the right fit?
Access latest and trending CPE courses with my CPE One Unlimited Access subscription. Subscribe now.
Yeah, it's funny you say that. Yeah. So yeah, if we can make it work. So I think the key to it is really completing what I'd call a target fit analysis early in the deal flow. And it's looking at things, we have a little grid that we use, and it's, strategic alignment, culture fit, service line synergies, what industries do they serve, operational compatibility. So that can get into
Yes.
things, like systems and how they work, and performance, how they think about performance evaluations and things like that. Geographic consideration. So there's all these buckets, right? And you can rate those things and determine whether there's a fit. And sometimes, like industry served or service line, doesn't have to be, well, those all align. In fact, many times it's going to extend an offering that you have, or it's going to get you into a new segment that you're not in, things like that. Sometimes the strategic play is, no, I want to deepen what I already have. Some it's, I want to get into something new. So it has to kind of fit your strategy.
Yes.
Maybe an example would help. So I was working with a $10 million firm recently, and they were evaluating a $10 million or $2 million target. So which was pretty significant for them. So they had done a couple of really small deals on their own, but they decided to engage us to help in the buy side process for this deal. And on the surface, it hit all categories like 100%. With the exception was, we need to dive into culture fit more, in a deeper way, because, that always can be a sticking point, etc. And, as it turns out, some of the question marks that were in the mind of the buyer ended up kind of playing itself out as they did some one-on-ones with the seller. And ultimately they kind of mutually parted ways because it just wasn't a right fit, even though, like, if you looked at it, it'd been like, this is going to be a home run in a lot of different aspects. And unfortunately it didn't work out in that case. But you mentioned at the start, sometimes a deal not done is the best deal if it wasn't going to be a fit.
Yeah, no, I completely agree to you there. And um, I think it's very interesting, how you put it, because, it's these things, like you said, and that's why I wanted to have this discussion. It's not just that because the numbers match, the deal is good. No, there's a lot more to this. And I want to talk about it, because one of
Yep.
the steps in a mergers and acquisitions process is a letter of intent. All right. And a lot of people have this misconception that once a letter of intent is signed, the hard part is over. But as you know it, LOI is close to where things can get messy. So can you walk us through what really happens in that stage, and what most people underestimate during this stage?
Yeah, absolutely. So before we get there, I want to back up one little step, because it's something that's starting to pop up more and more in the accounting profession deals, and that's the indication of interest stage.
Yes. Yeah.
So, I don't know if you've talked about this on some of your other podcasts, but one thing I think that's challenging for firms is if they're not ready and don't have a proactive strategy towards M&A, and they get deals that are crossing their, desk that have a IOI component and, an indication of intent, that can be a really challenging step for folks. So in essence, investment bankers will flood the market with their teaser sheets, right? And in order to get to the next stage, you have to put an indication of intent out
Indication of
there,
interest. Yeah.
interest, and that has to include some elements of what a deal would look like as well as a proposed valuation. And a lot of times they'll give you it feels like a day to return it, even though it's probably like a week. And if you don't have kind of your process, you're going to miss out on potential opportunities that are on strategy for you. So that would be one recommendation is to kind of think through that process, as you're getting into this M&A world. Then obviously when you get to the LOI, once you get to that phase, and there's some, back and forth obviously to get through that process, but a lot of times you get to a narrower pool of buyers, and probably you either exclusive, which you could work out, or maybe there's one other potential buyer that you're negotiating with. So then you get into the due diligence phase, and this is we talked about a little bit about this, but it's full fledged and it's going to take a little bit of time, right? In most of the time at this phase, the sellers are pretty open about everything that's going on, but you do have to dig at times. You're looking at things like historical performance, you're looking at client concentrations, the tech stack. One that can always get a little bit intriguing is the HR policies. I found is differences in how you pay people. Invariably, health insurance changes because that, employees kind of do one of these when you want to change their health insurance. And then the one that seems like it would be relatively easy, but tends not to be, are things like sick leave and time off, because people are well guarded on that, and the HR professionals know what their employees kind of will give and take around that. Even though in general it probably is not that different, but you see that. Comp philosophies, non-competes, all those little things can cause headaches in the deal process. So spend your time understanding really what those things are all about.
Yeah.
I mentioned the legal liabilities and compliance that can be sticking points. So try to get on those sooner rather than later. And then don't forget about things like peer review, and because that can cause problems if you don't dig into that.
Yeah.
I know we always had a step. It's like we reviewed some sample audits, we reviewed complex tax returns, reviewed some output for advisory engagements. So you really understood, is this going to be in alignment with our practices or not? And at times, sometimes they're not. And you have to work through that.
Yeah. Yeah.
So there's a lot there, right? And it takes
Yeah.
time and
There's a
energy.
lot. Yeah. Yeah.
Yeah.
In fact, I did a podcast with this lawyer, Roman Bassi, and he talked about the binding and the non-binding elements that are mentioned in the LOIs and IOIs. And a lot of people are like, oh, it's binding, right? So I got hold to it, and this is non-binding, so I can. But there's a lot of confusion there. So I covered that as well in that podcast. But you rightly point out a real thing. And the thing is, when we talk about mergers and acquisitions, especially in the accounting profession, private equity is no longer an alien word in the industry. It's been accounting firms have been a subject of interest for private equity firms. It's on everyone's mind, and the way our industry is shaped, a significant portion of them, 70% of everybody who is owning an accounting firm, they are going to be retiring in the next 5 to 10 years. But you've been vocal that too many firms are rushing into these conversations with private equity without a strategy. So why do you think that's happened?
Yeah, it's an interesting thing. And, when I was in the leadership role, I saw this from a lot of firms because I interacted with a lot of, my peers in the larger firms during that time. And it always felt like the accounting profession was like a kid's soccer game where the ball was kicked one way and the whole pack goes in that direction. The ball shoots across the field and the whole pack goes that way. I don't know exactly why that is. I think, I think when you look at firms, especially the larger ones, if you change the name on the website and put and just looked at it, the firm from one firm to another doesn't look all that different, right? They serve similar industries, they have all the same services, they might articulate their mission and vision, their values a bit differently, but most of them will have some similarities in that as well. So I think there's this element of a sea of sameness. So, when the first couple of deals in private equity went down, I think all the firms were like, well, ooh, they're doing it, so now we have to look at it. And I like to say, like, hey, rather than rush into this, let's figure out what's your strategy and vision. And then ultimately, it is a capital source, which is really what it is. It's not necessarily a strategic decision. It's a strategic decision to change your capital structure and your governance structure. And I think too many people are saying, well, I'm going private equity and really, well, what does that really mean? No, you're taking on a capital partner. That's a whole different conversation, right? And so I tend to look at it as like firms grew and invested in itself for decades and decades without private equity. So why all of a sudden are we saying, well, all the firms have to be private equity? Now, again, this is not saying that private equity is good or bad. It's just saying, do it for the right reasons.
Yes, do it for the right reasons. In fact, I read a book by Brandon Poe. He wrote a book on how to sell your CPA firm. And the very first chapter, if you are really in that mindset that I'll probably need to exit sometime or the other, the very first thing you got to do is perspective. You got to have a perspective. Why do you want to do this? Whatever you want to do, whether you're looking to sell or whether you're looking to bring in an external capital for whatever reasons. Why? What's your perspective then? What do you plan to do with it? Have that perspective clear and then go forward with whatever you want. So, I think that's the strategy that a lot of people are, falling behind on. And I want to talk to you about this. Another thing that I'd spoken to this other gentleman in one of the prior podcasts. And he says that, whenever you're thinking about, for whatever reasons, if you're thinking to either bring in private equity for whatever reasons, or you're looking to sell, the firms, everybody says this, you need to get your house in order. All right. So what does it actually mean in practice? Are we talking about financial hygiene, leadership alignment, client mix, or all of the above?
Yeah, well, it's probably all the above. I'd say at Winding River, we're focused on kind of 6 core table stakes for firms when they're thinking about it. You can kind of phrase it around what I would call a value creation plan inside the firm. In many ways, it really starts out, and all the rest of them, to me, kind of come off of this one, and that's, do you have your North Star and your vision defined? And most of the time, when I'm talking with firms, they don't know what that really means. And so we'd spend a lot of time on that particular topic. In fact, I'm working with, one pretty sizable firm in the top 100 on that very thing right now. And, and kudos to them. They got themselves out of the thinking, what I call Horizon 2 thinking, and what that really can mean for them. And it's hard and challenging. But once you have that in place, then I think you got to focus on developing your strong leadership team. So a lot of times, firms have had, leaders that have come up through the firm, and I was no different. So, I learned how to be a growth officer. It wasn't something that, and I had to work hard at that, right? And you got to spend the time. But you're seeing a trend right now that firms are bringing in external talent into their leadership roles, which is a judo flip for a lot of firms to even think about. But you're starting to see that because private equity is going to look at the quality of your leadership team, and they're going to want to, that can be a positive if you're going to end up going that route. Or if you're going to stay independent, having some of those roles filled by external folks that have been in those roles in other places can potentially be a benefit. Not saying it's the only path, and I think there's a balance there. I think you should have some element of historical folks on your leadership team that came up through the firm, as well as, infusing with some outside talent. Third, we focus on partner alignment and corporate governance. So, corporate governance can take on a lot of different aspects. It's, what is your board makeup? Do you even have a board? You should. It should be independent of your leadership team. What are the decision makings? Most smaller firms, it's an executive committee that, doesn't, you don't have. So, and that takes on different forms. I mean, if you're a $5 million firm, it's going to look way different than a $30 million firm, than a $100 million firm, right? So it has to fit your size and where you are in the evolution process. Then I would say, how is your firm succession? Are you developing leaders? And so that can take on many flavors as well. Then you get into partner buy-in and buyout.
Yep.
Do you have the proper things in place? Now, obviously, private equity investment is going to change that regardless. But when you're making this choice, evaluating the alternatives is also part of the equation, or at least it should be. So that definitely has to be part of it, because private equity has changed the game when it comes to deferred comp plans.
Yep.
And then last on the 6 would be developing an investment plan and capital plan for your firm. I think we talked before, when you go back decades, firms have made investments probably without really understanding the amount of capital that they've already invested in their firm and what the ROI on those investments really were. So putting a framework and a system in place so that they can track those investments, I think, is really important. And then all those 6 really are upheld by a strong client and growth plan, as well as a talent plan. So it's kind of the 6 plus 2 a little bit. It's those 6 things plus that foundation of clients and talent.
Nice. I really love how you put it across, pearls of wisdom, if I were to call it. All right. So, thank you, Brian, for sharing that. Now, you talked about, a deal which fell apart because of a cultural fit issue, and a lot of people think that, cultural fit is a soft issue, but it cannot, like you rightly mentioned, it can actually make or break a deal. So, in your experience, what are the most overlooked aspects of cultural fit in accounting firm M&A?
Yeah, so I think I was thinking about this one a lot. I'd say it starts with core values and mission alignment at first, because if you start there and there's misalignment, those things don't change on a dime, right? They're kind of baked into the ethos of the firm. So it kind of starts there. Then I would turn to performance culture spectrum. So depending on where firms are on that spectrum and kind of that tolerance aspect, and I can think of a situation that we had doing a deal where this firm was very high performance-based culture. They ended up having a lot of, with due diligence, we found there was a lot of turnover in the firm. And then there was also some compensation misalignment, which I'll talk a little bit more about that. And when we ended up doing that deal, but it was a harder integration because you had to morph that performance culture over time, and it was a challenge. And if you kind of look back and say, we probably wasn't as successful from a return perspective during the short term because of those issues that we had to get over. Then, on the compensation side, I think that one's really important to dive into early, because if you have misalignment there, if you don't deal with that up front, you're going to live with that for the life of those partners coming into the firm. And have countless examples of ways that if I look back, we probably would have handled a couple of situations differently. And then maybe one that you don't think about, but I'll throw this in there as a little nugget, is branding. It's amazing at how, firm names and branding and those elements are just ingrained in who the firm sees themselves as. And from a buyer perspective, it gets to be a sticking point more often than you think it might be.
No, I agree to you there. There's a lot to talk about on that, but that's for another podcast. But
exactly.
So let's say I'm a managing partner of a 2 or 3 million boutique firm, all right? And suddenly I'm joining a larger platform, all right? I'm merging into a larger platform. So and I'm sure you come across your situations. So I'm just trying to role play here. Let I'm merging into a larger platform. How do I mentally prepare myself and my team for that kind of stuff?
Yeah, I'd say that's one of the most challenging aspects of bringing the smaller firms into a bigger firm. And most of, I mean, in all cases, there's the managing partner in all firms, right? That's going to be coming in. Most of the time, you want them to be around, but it's
Yeah.
what role are they going to play? So if you're the managing partner of the smaller firm, I think you have to go through much of the same process that I was talking about in my own journey for
Yeah.
yourself. You know, what things are important to you? What are your passions? What are
Yeah.
non-negotiables? What do you see as that next phase of your career? All those
Yeah.
different things. And I'll tell you, it's a process to go through. And I've
Yeah.
seen it countless times, some that actually worked out, and then some that didn't, you know.
Yeah.
And what I always tried to do from the buyer perspective was, what role could I see this person in, and
Yes.
actually help them visualize what that could look like. You know, and
Yes.
it needs to be something with some decision making power because they're used to
Yeah.
being the person, right? I
Yeah.
mean,
They used to being that
and
guy. Yeah.
yeah, exactly. So you have to have the empathy for that on the buyer side too. And sometimes you miss that component, is that, you know, put yourselves in their shoes like we're doing right now, and understanding kind of the mental gymnastics that are going on in that
Yeah.
aspect. So if you can present them with a role that is going to have, that fits kind of what they're looking to do, but also has decision making power, I think
Yep.
actually in some aspect, and you know, obviously defined because it's going to be a way different role than they're coming from, I think it can work out.
Yep. 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 And you said something that I think a lot of listeners would need to hear. Private equity isn't for everyone. So can you expand on that?
Yeah, you know, I said before that it's, you got to be making it for the right reasons, and you
Yes.
also, you know, and it has to be a capital decision and a strategic decision combined,
Yes.
right?
Yes.
And so I think if you can start with that vision and get that North Star down, and I'm kind of a broken record on this, but I think it's so important that I'm going to keep saying it. Um,
Yeah.
that if you get that in place, it's going to help your decision making process. And then it kind of comes down to, you know, do you have an entrepreneurial mindset? Do you have an ownership mindset that you want,
Yes.
you know, and if you're saying yes and yes to those, and then maybe growing your platform and doing all the things that private equity would make you do, is maybe a better choice for you, right? And it's kind of, you know, and if
Yeah.
your partners are in a similar mindset, which hopefully they are and they're aligned,
Yeah.
then you should look at alternatives and at least understand what those alternatives are. And I think a lot of people are saying, what? There's alternatives?
Yeah.
I didn't think there was
Yes.
any.
Yes. Yeah. So what are those alternatives? Just from a curiosity standpoint, if not private equity, what are some alternative ways firms can create value and scale?
Yeah, I mean, when you look at the market, I mean, at the end of the day, our economy is run on small and medium-sized businesses, right? And you now have 16 firms that are over a billion in revenue, and they all seemingly want to go up market. So there's a huge amount of our economy that needs to be served, and be served
Yeah.
in still what I call more of a boutique way, right? And high
Yes.
touch, etc. So first and foremost is understand your market and understand how you
Yeah.
want to serve clients. So I think that's first. But then when you look at the smaller firms, I'd say that there's kind of this middle market squeeze in a lot of cases, and you have to either choose to scale or and it's not a binary choice, but I'll just kind of say it for the sake of this discussion: scale or specialize. And when you
Yeah.
specialize, you can go deeper. So, you know, I look at it like every firm, but small firms in general, all have Legos that they, you know, they use this Lego term, right? You know, they all have Legos, and if you take them all apart and look at the Legos on your desk and go, oh, well, how do we put this back together, you know, in a different way, and not following, you know, the paint by numbers that the Lego box has, but it's actually being a master builder and creating something different, right? So
Nice.
all firms have these Legos that they can put together. So what is the secret sauce that you can build on and actually, you know, create something that's really, really valuable on the back end?
Brian, I gotta give it to you, man. You got a beautiful knack for breaking down something very, very critical into such an easy to understand way. That example of Legos, it resonates so perfectly well. I mean, I don't know what to say. I mean, this was a masterclass. This was really great. So, Brian, this podcast has been such a reality check and a roadmap at the same time. So, before we wrap up, right? If someone wants to connect with you and learn more about Winding River, what's the best way for them to reach you?
Yeah, absolutely. So first of all, I'll say connect with me on LinkedIn. I use LinkedIn quite actively, so drop me a message there or email me at bblaha@windingriverconsulting.com. You also can link through the website as well. Check us out. Happy to connect and talk deeper about any of your listeners' strategic or inorganic, organic growth strategies, whatever it comes to. We can, we're here to serve.
Absolutely. And folks, except for the email, I will be listing out a lot of those details in the show notes, the websites, and the LinkedIn and everything, so you can connect with Brian with that. And with that, Brian, I want to thank you again for sharing your insights today. And to our listeners, if you enjoyed this episode, make sure to follow Accounting M&A Insider wherever you get your podcasts. With that, thank you everyone for joining in. Until next time, take care and keep innovating in everything that you do. Cheers.
Access latest and trending CPE courses with my CPE One Unlimited Access subscription. Subscribe now